We're putting artificial intelligence to the ultimate test. Can it actually outsmart a real caffeine-fueled accountant with 20 plus years of experience when it comes to saving tax? We're going to break down exactly what AI gets right, where it might lead you astray, and what this means if you're trying to grow your business. By the end, you'll know if AI is your new financial best friend or just another trend, and one that might land you in hot water with HMRC even. But don't worry, whilst this experiment is interesting and in some cases just flat out funny, by the end of the video, you'll be furnished with some simple, applicable strategies that will help you with your business finances. So let's see how well it does. So first, let's set the scene. We're going to be using the free version of ChatGPT, the one that's accessible to everyone and probably the one you're most familiar with. Here's the business we're working with. It's a limited company. It's got 100,000 annual turnover. The director currently pays themselves a salary of 9,100, topping it up with dividends. There's one employee on the payroll earning 30,000. All the work is carried out from the director's home. No fancy office space. Yet. The director uses their car for business travel. They also pay for training and subscriptions related to their work. And looking ahead, the business is thinking about reinvesting profits, buying new equipment, and maybe even making some pension contributions. We're going to prompt ChatGPT to act as a UK tax advisor, because if you've ever used an AI chatbot before, you'll know you have to be quite specific. It can be a bit of a petulant child if you let it. And we're going to set it a clear mission: save us £10,000 in tax. Not a wild figure, but something realistic for a business of this size. All right, let's fire up ChatGPT and see what it comes up with. Now, ChatGPT has spoken. It's given us 7 tax-saving strategies, but how do these actually measure up to the mind of an experienced accountant? Yes, I do mean me. So let's start with the first strategy it's given us: director's salary optimization. Well, let me tell you, we're already facing some issues right out of the gate. ChatGPT told us to pay the director $12,570, claiming it would be tax-free. Sounds great. Who wouldn't want free money? Except it's not really free as of the 25-26 tax year, is it? As of the 6th of April, the employer national insurance contribution threshold drops to just £5,000. Anything over that triggers 15% employer's NIC, not 13.8%, and certainly not free. To give credit where credit is due, in this specific scenario, since the business we're working with has an employee, you could claim employment allowance to avoid incurring any employer's national insurance. But the only reason we notice this is because we're looking at it through the eyes of an accountant. ChatGPT doesn't mention this at all. So, in short, without understanding how NIC thresholds work, you'd potentially end up paying more tax than you need to. Or you might even be missing out on claiming allowances your business might be eligible for. Refer back to employment allowance. Next up, dividend strategy. And guess what? Yep, some more misinformation. As much as we all want a £1,000 dividend allowance, that's old news. Thanks, HMRC. From April 2024, it's slashed to just £500, and it's the same for this year coming. Plus, it painted dividends as this magical 8.75% taxed income without explaining the corporation tax layering that happens first. Salary reduces company profits. Dividends are paid after profits are taxed, which is 19% for company profits below 50,000 and up to 25% for anything over. Dividends aren't always cheaper, and if your company profits are high, which in this instance with a £100,000 turnover they just might be, it might be worth ditching dividends altogether for a higher salary. This example of ChatGPT giving us outdated advice is why it's so important to make sure there's a human in the loop to check for inaccuracies. And as a comment below, who's been frustrated with AI chatbots that promise to level up productivity or save you time or money but actually don't really deliver. Now, moving on to pension contributions, I think we might finally have a winner. ChatGPT correctly said pension contributions are tax deductible, and yes, the 60,000 annual allowance is spot on, but it made it sound way too easy. You need to prove the pension is wholly and exclusively for business purposes. Plus, you actually need the cash to fund it, and you need to set up a separate pension scheme so you can make contributions from your limited company. And once the money's in, it's locked away until retirement. There's no popping back for it next summer. So again, some correct info, but it's the same as going on to HMRC's gov.uk website. The info is there, but it's not specific to you or your business, and it doesn't clarify the potential variables, which a real human accountant would do when looking at a business's finances. Now, moving on to what should be a simple one for AI, allowable business expenses. But I can already see that whilst it gives good surface level advice, it's also made a grave mistake. ChatGPT does spot that you can claim use of home costs, but once again, it oversimplifies the whole process. For example, it mentions claiming a portion of your home office expenses, but doesn't explain how to actually calculate the amount you're allowed to claim. And to make matters worse, it casually suggests claiming mortgage interest without even mentioning the capital gains tax potential trap that could cost you thousands when you sell your house later. So just a casual mistake then, nothing big. But wait, the problems don't stop there. When it comes to your business vehicle, ChatGPT makes a massive blunder. It actually suggests claiming running costs like fuel, insurance, repairs, and mileage, which would basically mean you're double claiming your travel expenses, which is a massive no-no. Oh, and it also tells you to claim capital allowances without so much as a whisper about the benefit in kind rules that hammer you if you're using a high emission petrol or diesel car. Unless it's electric, you can end up with a tax bill big enough to need its own parking space. You might as well stand outside HMRC's office waving a big red flag. Look at me, over here, if you followed this advice blindly. Moving on, the old defer income, accelerate expenses trick. It sounds smart. It even sounds a bit Wall Street, but unless you understand accruals accounting and your actual goals, it could totally backfire. For the business that we're working with, the director wants to invest the business profits, but if you're blindly deferring that income to avoid corporation tax, what profits are you left with to invest? So in this case, as opposed to giving bare bones advice, ChatGPT is now just flat out ignoring the information I gave it at the start. Some businesses benefit more from actually showing a higher retained profit to show strength for lending and investment, because it strengthens their financial position in the eyes of external parties like banks and investors. When lenders review a company's financials, they often access profitability and reserves to gauge the business's ability to repay loans or withstand financial shocks. Therefore, just aggressively deferring your income or boosting expenses to lower tax might unintentionally make the business look weaker on paper, and that hurts its chances of securing funding, better lending terms, or even investment deals. This next one is hugely niche. R&D Tax Relief sounds super exciting, but what you'll actually find is most small businesses don't qualify, especially if you're not doing technological or scientific advancements. And also from 24-25, the scheme has changed slightly with lower generosity unless you're a loss-making company. Throwing an R&D here is like suggesting a Formula One pit crew for your company car. Impressive, but totally unnecessary. Although I'd imagine they can do an annual service a little quicker than leaving your car with dodgy Ken at his garage round the corner. And finally, this next one is just complete overkill. ChatGPT suggests setting up a holding company, but most businesses turning over 100,000 are really, they're not going to be dealing with group structures or strategic loss utilizations. I mean, the phrase holding company is just thrown in with no mention of the increased complexity and costs For example, you've now got 2 sets of accountancy fees. There's the additional compliance to worry about, making sure you're filing on time, everything's where it needs to be. Not to mention the impact on entrepreneurs relief or group tax rules. It sounds smart, but it's terrible advice if you're just trying to pay less corporation tax this year. So, what would an actual accountant recommend? Here's the real game plan. Set the director's salary to maximize tax efficiency. For 25-26, the employer NIC threshold drops to $5,000. Anything above that normally triggers 15% employer's NIC. But because this business has 1 employee already, they're earning $30,000, but it's kind of irrelevant how much they're earning. You just need to have a second employee. It qualifies for employment allowance up to $10,500 from April 2025. Employment allowance cancels out the employer's NIC cost on the director's salary, meaning you can increase this to $12,570 to maximize your full personal allowance. So that's already $2,388 saved in corporation tax if you're paying it at 19%. However, as an accountant, we would be asking what the plans are, as potentially taking all income through salary will save you more. As for dividends, you've got a £500 dividend allowance, so that's tax-free. And then dividends you take within the basic rate band up to $50,270 total income are taxed at 8.75%. Now, you can take out any money you need, but if you're looking at investing, leaving profits in the business not only builds capital, but defers personal tax as well. If you defer any unnecessary drawings out of the business and you keep your profits within the business, suppose they decide to leave in $24,000 in this year instead of taking it, they're going to avoid £2,000 in dividend tax. Plus, you'll keep more cash in the business for growth or future tax efficient withdrawals. With your company pension contributions, so these are tax deductible for the company, so they do reduce your corporation tax at year end. The company can contribute up to $60,000 per director or your total earnings, whatever is lowest, in 25-26, without triggering any benefit in kind charges. For this scenario, let's say you make a $20,000 contribution through the limited company. That's $3,800 saved in corporation tax at 19%. When it comes to use of home, you've got a couple of options with that. You can use the simplified flat rate, which is £6 per week, $312 per year. No questions asked. It's super simple. There's no impact on future capital gains tax either. Alternatively, you can claim a proportion of actual household costs, utilities, water, broadband, council tax, etc. using this calculation. Your total home costs divided by the number of rooms times the number of rooms used for business times the time used. But be aware of CGT implications if you claim part of your mortgage interest or dedicate part of your home exclusively to business use. There are different things you can do to help with that and to avoid it, but you know, if you're looking to sell your home in the future, you could lose some tax relief of CGT. We usually recommend using whichever figures come out highest for you, but for the sake of this challenge, we'll just use the benchmark rate of 312 since we don't know the direct costs for this business. So that's around another £59 saved on use of home alone. So in total, we're up to $8,247. Now you'll need to be smart with your business car. If you use a petrol or diesel car through the business, you're going to get whacked with a hefty benefit in kind tax charge. It's just not worth it. Electric cars, on the other hand, have a 2% benefit in kind rate in 25-26. Very tax efficient. If it's not electric, it's better to claim business mileage instead. 45p per mile for the first 10,000, 25p thereafter. And for the company, assuming the director's using their own personal car for business purposes and they've driven the full first 10,000 miles, That's £855 saved in corporation tax. And another little neat trick with mileage, that it's also due to be reimbursed to the director tax-free. So that's £4,500 back in your pocket, tax-free as well. As for reinvesting your profits sensibly, you can do this by investing into new equipment, technology, plant and machinery. Qualifying purchases can be claimed under full expensing, so 100% first year allowance. That means every £1 spent knocks 19p off your corporation tax bill. So if you spend £8,000 on some new IT equipment, monitors, desks, chairs, etc., that's £1,520 saved in corporation tax. All in all, with the above strategies, we've saved around £10,622 and kept HMRC well away from finding reasons to pry into your accounts, more importantly. Here's the thing, AI can give you information. It can even sound smart, really smart sometimes, but only a real accountant knows if that information actually applies to your specific situation. Because running a business isn't about ticking a few boxes and copying what sounds clever. It's about understanding all the little details that make up your business and makes your particular setup unique. Things like the size of your business, your future plans, your cash flow, your goals. AI doesn't know any of that. It just works on what you feed it. And let's be honest, if you're not asking the right questions, you're not getting the right answers. Saving tax isn't just about ideas, it's about knowing which ideas apply to you right now and how to use them properly.